we want to kick this off. And, I want to thank First Integrity Title Company for hosting this. This is a webinar on 1031 exchange basics for one CE credit. And just to let you know, we'll be following up. So you've got to stay on screen for the entire class, for the entire 60 minutes. Secondly, we'll be following up by email with the form where you just attest that you were on this for the entire time period. Then we'll follow up at Asset Preservation with the certificates for this. But I want to thank First Integrity for hosting this. They wanted to bring valuable information to you in the marketplace that not only gets you CE credit, but helps you as real estate professionals put more deals together, help your clients out, and really understand a powerful tax strategy that's in the tax code. Quick disclaimer, we're not giving tax or legal advice, even though we're talking about the tax code. So everybody should review their specific situation with their own tax and legal advisors. I'm not going to go through all the bullet points on this outline, but as you can see, we're going to cover a lot of information in a short 60-minute period. Now, what I wanted to do is I wanted to start off right away. What I wanted to do was start off right away with some terminology for you. And this is important because you hear some of these buzzwords. So let me go through just a very simple definition of some of these words that you have here. Actual receipt is when somebody receives money. So they receive the money and that becomes taxable in a transaction. Now, boot is a term that you'll hear quite a lot. Boot is simply defined as non-like-kind property. And there are two types of boot. The most common type of boot is what we refer to as cash boot. So cash boot is money that you get from the transaction and you receive it and it becomes taxable. So it's when the taxpayer takes money out of the sale. So they close with First Integrity Title, they receive some money right away, that's taxable, or you can receive cash boot at the end of the transaction. In both cases, those are taxable to the extent you have gain. The other type of boot is called mortgage boot. Now, mortgage boot is when you have a reduction in your mortgage liabilities on the property you're purchasing, we call the replacement property, compared to the property you sold, the relinquished property. And we'll look at through an example of this. Constructive receipt is when an investor, even though they don't necessarily have the money in their pocket, they're legally entitled to the funds in some manner, such as having it held in an escrow account or a trust account or something like that. And where this comes up is if somebody closes and they don't set up an exchange, even though they haven't touched the money, if the burdens and benefits of ownership have transferred from the investor to the buyer, they then have constructive receipt of the funds. Direct deeding is something that happens in most exchanges, particularly delayed exchanges. And this is the direct transfer of title from the investor to the buyer, and then from the seller back to the investor. You'll hear me refer on the next one to the investor, sometimes as an exchanger, taxpayer. Essentially, it's your client as a real estate professional. The exchange agreement, that's the agreement that's prepared by the qualified intermediary that basically says your client's giving up X amount of property. The qualified intermediary owes them the property or money back within a certain period of time, within 180 days. The exchange period is a maximum of 180 calendar days. Now, interestingly enough, it can be less than 180 days in one situation. And in one circumstance, it can be longer than 180 days. Can you see my screen? I just got your text. Can everybody see the screen all right? You can see it. Okay, thanks. Good. The exchange period is that, so maximum 180 days. The identification period is a 45-day period from when you close on the sale to when you have to identify. And we'll get into more detail. Like-kind property, any property held for productive use in a trade or business or for investment. So it's property that you hold for investment, and it can be very, very broad. We're going to unpack this, but it can be bare land, a single family rental, commercial property. Here in Colorado, we do a lot of exchanges on vacation homes held for investment. And I'm going to talk about that as an option there. Somebody's telling me that they're just seeing me, but not the PowerPoint. Hold on a second here. All right. Aaron, confirm if you can see the PowerPoint there. Qualified intermediary is the entity that facilitates the exchange. All right, I'm hearing that you guys, hold on just a moment. I'm hearing you cannot see the PowerPoint. So just a moment, I don't understand. Sorry about that, everybody. Give me just a quick moment. Yep, I got it. Somehow it went off. All right, are we better now? All right, excellent. So qualified intermediary facilitates the exchange, and they're that entity in the middle. They're really critical. They actually hold the proceeds. They prepare all the paperwork. Relinquished property is the property that is given up. Sometimes you're called the sale property, sometimes the phase one property, or sometimes you'll hear it called the down leg property. The property being purchased is what we call the replacement property, sometimes called the phase two property or the up leg property. And then finally, we use something called sequential deeding in what we call parking arrangements, reverse and improvement exchanges. So just a little update of what's going on in the market. You know, it's very, very limited on inventory. Now, these are national statistics. Here in Colorado and the Denver metro area, we actually have a lower supply. So right now, it's really an inventory issue, and that's having such an effect on prices. In terms of 1031 exchanges, we're literally doing double the activity now than we were just a couple of years ago. And then the other thing to kind of keep in mind is we still are seeing a trend a little bit out of multifamily and into single family residential, and a huge uptick in activity with people exchanging into vacation markets. So I'm sure most of us are familiar, places like Summit County, Vail, Aspen, Steamboat Springs, tremendous increase there. Might have softened it a little bit in the last few weeks, but over the last 2 years, it's been strong. And then the last one is we're seeing a lot of states on the West Coast. We see investors coming from California. They're going to Arizona, Idaho, and Colorado. On the East Coast, we're seeing people come out of New York and New Jersey, and they're exchanging into Florida. They're exchanging into Tennessee. So those are just a couple of the national trends that we see going on. Now, the topic of today's class is 1031 exchanges. This allows any investor to take any property held for investment or used in their business, exchange it for another like-kind property, and defer paying all 4 levels of taxes. It is an extremely valuable tax planning strategy. In fact, we have this available to us in the code with real estate. Nothing like this is available with stocks and bonds and other investments. So real estate investors have a huge advantage because you can exchange over and over and over again. As long as you exchange for other like-kind property, you can continue to do that over and over. Now, simply put, when we look at a taxable sale, somebody sells a property, they transfer it, and they get back cash. With an exchange, they give up a property held for investment, and they get back a like-kind property also held for investment. So think of sale, property for cash, an exchange, property for other like-kind property. There are a lot of reasons why people might want to do an exchange. Sometimes they may want to consolidate, take some smaller single-family homes and maybe roll it into a multifamily. A lot of people do exchanges to diversify. They have a lot of equity in one property and they want to split that up into multiple properties. And they might do that within the state of Colorado. They may buy some replacement property here and maybe exchange into other markets. Obviously, leverage is a great strategy. If you've got a property that's free and clear, you can get a lot better ROI by adding some leverage to it. Cash flow, people might want to exchange out of bare land that's gone up in value and go into income producing property. Many people use exchanges to improve their returns, and some do it to do value adds, and some for estate planning purposes as well. Now, your clients really, when they own an investment property, they just have 3 options. Number one, now they can do kind of a buy and hold for the long term. The only challenge there is that you want to be in a market where you've got a lot of good economic fundamentals. So I'll pick on Pueblo, Colorado. And not that there's anything wrong with Pueblo, but if I have a property in Denver Metro, I'm pretty sure that the Denver metro area is going to way outperform a market like Pueblo over the next 20 plus years because there's a lot of job growth, because people are moving here. There's upward pressure on rents and prices. A market like Pueblo may slowly tick up, but there's just not as much happening in that particular marketplace. So buy and hold is great if you're in a good part of the economy. Now, the other option is that you can sell the property, pay the taxes that are owed. And we're going to go through them, but you've got basically 4 different taxes that you've got to pay. By the way, just a quick reminder to you, for the CE credit, it's required that you actually show your faces. So if you're off camera, would you hop on? We've got somebody monitoring the class, and you've got to have your face and be on camera for the entire class if you want the CE credits. So just a little housekeeping there. Some people do want to sell and pay the taxes. The challenge is you're not going to get nearly the return on investment. After you pay all your taxes, now you've got the net equity available to redeploy into other property or other investments. And when I do an exchange, I have the entire gross equity available where I can get a lot better return on investment. So with an exchange, you've got essentially pre-tax dollars. If you sell, you're going to have after-tax dollars to redeploy. And then finally, keep in mind, you can do a 1031 exchange, and many people do fully deferred exchanges where they defer all the taxes. Some people opt for a partially deferred exchange where they take some boot out and pay taxes on that and maybe buy 1 or 2 replacement properties. So keep in mind, an exchange is not an all or nothing proposition. And I find a lot of times investors are surprised to learn that they can do a partially deferred exchange, get some of the benefits, and still pull some money out and just pay taxes on the money that they actually pull out. Now, here's the boring stuff. Here's the actual tax code itself. It says, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. Now, a couple key takeaways from this. Number one, we call this non-recognition treatment. So we're not recognizing it on the tax return. Sometimes you'll hear people mistakenly refer to these as a tax-free exchange. And that's really kind of a misnomer. It's really a tax-deferred exchange. So the basis of the property that you're selling gets rolled into the basis of the replacement property. That's what happens there. So just keep that in mind. The types of property, you can exchange business for business, investment for investment, or business for investment, or investment for business. And we're going to look at this again a little later. Like kind is so broad, but keep in mind, only real property qualifies for a 1031 exchange. So any personal property does not qualify. Only the real property components do. There are things you can't exchange, and I just want to touch upon a couple of bullet points here for you. Stock in trade or other property held primarily for sale. So if the intent is to hold it for sale, you cannot do a 1031 exchange. So think of maybe the home builders in town. They put up a subdivision, they're going to have to pay taxes on that because the intent is to hold it for sale. In our real estate world, the common term for this would be somebody that maybe does a fix and flip, right? They buy an undervalued property, they do a renovation on it, and then flip it for the increase in profit. That, even though they make money on that, that does not qualify for an exchange because it's being held for sale, not being held for long-term investment, i.e. rental income. So keep that in mind. And that's something, at Asset Preservation that we can certainly walk you through some different options and kind of analyze the specific facts. I want to draw your attention down to the 4th bullet point. An interest in a partnership does not qualify. So a partnership interest or a member interest in an LLC is excluded from 1031 tax deferral. And yet, many of us hold title on investment properties in LLCs and partnerships. Very, very common. So there are some planning considerations, some different ways to structure this. Probably the most common is to do what we call a drop and swap. So to drop out of the LLC or partnership, deed it out to the various partners where they now co-own it as tenant in common, and then later do a 1031 exchange. And I'm just giving a kind of a cursory overview of that strategy. There's a little bit more involved, but the bottom line is, we do have some ways that you can kind of work around that particular issue, but it needs to be done in advance of the closing. And a lot of times people are not aware of that. Now let's go to the fun topic. Let's switch gears a little bit. Let's talk about taxes. Um, Taxes for everybody, whether it's in real estate or even income taxes, are the single biggest wealth destroyer, right? It's not what you make, it's what you keep that matters. So when we look at capital gain taxes, often at asset preservation, my associate Aaron and I are asked, what's a capital gain tax? And what we have to explain is there is no capital gain tax. There are 4 different taxes. First off, any depreciation recapture is taxed at 25%. So if you have a client that maybe has a single family home in Englewood and they've owned it for 20 years, they would have to recapture 20 years of depreciation if they do a taxable sale instead of a 1031 exchange. So right off the bat, that's a pretty significant tax hit. Then the remaining federal gain is going to be taxed at the taxpayers' tax rates for the gain. Lower income filers, 15%. Those that are higher income at 20%. And a lot of times when you don't do an exchange, that's going to push the taxable income into a higher bracket. So most people will probably be facing locally here in our marketplace about a 20% tax rate. Certain taxpayers are going to face what's called the net investment income tax. This is an additional 3.8% surtax on what is called net investment income. Then that includes capital gain. So a single filer that has any more than 200,000 of net investment income pays the 3.8. Married filing jointly pays it at 250,000 on up. So you'll just notice there's really a big marriage tax penalty. If it were equitable, it would have been 200,000 and 400,000, but it's 200 and 250,000. And then finally, we've got state taxes. So here in Colorado, we're at 4.63. So we're not at the highest rate, but yet some of your clients are coming from California and they're choosing to invest in Colorado. They can be facing the highest tax rate in California, which is 13.3%. So it's a fairly significant issue there. And by the way, there's a question. I'm seeing a whole bunch of questions there. I'm going to try and address those at the end. I've seen a whole bunch of them coming in. So let me just kind of get through the class. We'll get the credit and then I'll kind of rapid fire do that. So thanks for the feedback. I want to make sure I get all the material in. Sometimes the material might actually cover the question. So the total taxes, depreciation recapture plus federal gain, net investment income plus state. You can see why that's a pretty big tax hit. Anybody that's owned real estate for more than a year in our marketplace here in Colorado is going to have significant gain. If you've owned it for 2, 3, 4, 5, 10 years, you're really facing a pretty big tax bite. And a lot of people are opting to not pay the taxes, defer them into the future, and go ahead and buy more replacement property. So all these taxes can be deferred when you do a 1031 exchange. Now, there's a concept that's kind of important. I want to talk about it here, which is when you're doing an exchange, you really want to look at how you're holding title to the property. If somebody relinquishes property, that tax owner should be the same tax owner that purchases a replacement property. So if the LLC relinquishes, typically that same LLC should buy the replacement property. So you'll see other examples on the screen. Now, where this gets a little interesting and where it comes up quite a bit is where you may have married couples that maybe have remarried and they both brought in separate assets. So the wife has her own assets, the husband has his. The wife relinquishes a property that she has held for investment, but yet they want to buy the property together, or maybe they need the husband's income to qualify, or whatever it might be, or it could be vice versa. Really important when you're dealing with that you look at who is the tax owner who's held it for investment, make sure that they buy the replacement property. So if the wife has held it for investment, the wife should purchase the replacement property. What sometimes comes up is we have people that'll bring up something and say, well, what about just quit claiming, putting on my spouse right before I close? You can certainly do that, but it doesn't necessarily help much for the exchange, because the key part, and you'll see me talk about this on the very next slide, is it's very important to hold property for investment purposes. Hold, which means you've got a period of time, and we'll talk about that in just a moment. The other thing you want to look at then would also be what type of LLC. Most people form what we call a disregarded LLC for federal tax purposes. So if I'm Scott Saunders and I have a single member LLC that's disregarded for federal tax purposes, it's really the same tax owner. Yet some people might have an LLC that is taxed as a corporation. So as you can see, when it comes to 1031 exchanges, there are a variety of issues. Now, in this 1 hour class, we're going to go through the mechanics, we're going to go through the time deadlines, and really some things that you need to consider. But I would tell you, whenever you do an exchange, it's really recommended that you get your client's tax advisor involved who can look at their unique facts and circumstances and give them tax advice. The way that we all fit together, you're the real estate professional, you're the expert on the real estate market and that whole closing process, right? We're the qualified intermediary. We hold the funds and guide them through the exchange process. First Integrity Title is the expert on the closing and title side and preparing all the documents to close the transaction. Then your client's going to need to get tax and legal advice, maybe looking at their structures and their entities. So we're a part of the team. You're a part of the team as a real estate professional. Certainly who's handling your closing is, but you also want to pull in the tax advisor. Really important to do that in 1031 exchanges. Now, the next slide I'm going to go through, there's a question that we get asked a lot. And here's the question before I kind of get into the answer, which is, how long do I have to hold a property before it's considered held for investment? What is that holding period? What's that safe holding period that the IRS looks for? And the answer I'm going to give you on the very next slide may be a little bit of a surprise to some of you that have been in the marketplace, but the reality is there isn't a holding period when it comes to Section 1031 exchanges. There's no specific period of time that you must hold it for. So the time period is important, but there's no set time period. And sometimes people say, well, they've heard a year or a year and a day or 18 months or 24 months. And those might be useful guidelines. And in a lot of cases, those types of things might make sense. But at the end of the day, the beauty of the tax code is this area is a little bit gray. What matters the most would be your client's intent to hold for investment, that their intent is to hold it for long-term investment. Well, what's weird about the whole concept of intent is it's really cerebral, right? It's in my head. What I intend right now is in my brain. So the IRS is going to look for objective, provable facts that either support the investment intent or contradict it. And in a perfect world, your client would have a lot of facts and circumstances that substantiate or support the intent to hold for long-term investment. So the time period is important, certainly. What you don't want to do is have a lot of things that contradict that. Now, I'm not going to go into the mechanics, but that very last bullet point of Riesing versus Commissioner, that's a tax court decision where somebody held it for only 8 months. And yet the IRS determined that their intent was to hold it for long-term investment. So those of you that maybe have heard you've got to hold it for a year or 2 years, that's not entirely accurate. And maybe there are some planning opportunities available to you and your clients with potentially a little bit shorter holding period where they could still do a legitimate 1031 exchange. So just keep that in mind. It's really a variety of factors, not just the time period, but it's all the factors stacked together. Now, what I want to unpack on the next slide is kind of an important concept, which is this whole like kind property. Unfortunately, there still is that myth out there that like for like means bare land for bare land or single family for single family. So let me kind of unpack what like kind property is. Simply put, it's any property that you either hold for investment or you use for your business. So you can exchange bare land for a single family rental. You can exchange a single family rental for a duplex or a fourplex, for a ranch, for a vacation home held for investment, for commercial, industrial, retail, apartment buildings, all sorts of property. So the bottom line is it has to be what we call real property, real estate, exchanged for other like kind real estate or real property. Personal property doesn't qualify. Prior to January 1st, 2018, you could actually do exchanges on personal property. So a farmer could do an exchange on all of their tractors and farm equipment for other farm equipment. We did exchanges of jets and artwork and all sorts of things. But when tax reform came about back in the end of 2017, they eliminated personal property exchanges. Only real property qualifies. But let me kind of share with you some things that you may not think of as being real property that qualify. First off, you can do an exchange on water rights. They're considered like kind real property. And here in Colorado, water is a very precious resource, and it's accorded the status of being considered real property. And that's very true with a lot of the drier Western states. An air right can be considered real property. So an air right would be if you've got the right in a metropolitan area to add some stories to your building, even though you don't build it, that right, it's called a transferable development right, that can be exchanged into a fee interest in other property. Another one that's really used quite a bit here in Colorado would be an easement. And there are different types of easements. There's an agricultural easement. There's a conservation easement. We did an exchange a few years ago out of a conservation easement in Boulder that was about just under $9 million that was exchanged for apartment buildings. So conservation easements qualify. Another one would be a perpetual communication easement. That would be a cell tower. So if you have on ranch or maybe in a downtown office building, a cell tower, and they form a perpetual communication easement, you can exchange that for a fee interest in any other type of property. So that's another thing that potentially qualifies. So as you can see, like kind property is broad. I don't have a slide on it, but some of you may have heard of something known as a Delaware statutory trust. So this is a slice of a larger commercial building that you own with other investors. And it's a little bit more of a sophisticated concept, but we've seen a huge increase in these types of transactions where an investor owns a piece of a larger commercial building, say an apartment building, with a bunch of other investors. That can qualify for a 1031 exchange. So it can't be a security. These are kind of interesting in that they're a hybrid. They qualify for a 1031 exchange, and yet the SEC considers them a security. So they're kind of interesting in that regard. By the way, thanks for the questions. I will try at the very end to go through them rapid fire. I see there's about 20 there in the bubble, so I will get to, or I'll try to get to all of them. And if I don't, I'll make sure that I follow up after the presentation to get your question answered. So Delaware Statutory Trust qualifies. One thing to be aware of, these are not sold through real estate professionals. They're sold through registered securities brokers that have the appropriate licenses. So financial planners sell them. And there's a whole bunch of issues, but I wanted to bring that up. Let's look at easily when we look at like kind property. The easier way to look at it is what doesn't qualify. Number one, the home you live in that is a primary residence, can't do an exchange on that. Number two, property held for sale. So somebody who's a dealer cannot do an exchange. In that regard, any other real property that's held for productive use in a trade or business can be exchanged, or held for investment can be exchanged for any other property held for investment or used in a business. And as you see at the very bottom, the last bullet point, raw land, commercial, single family rental, multifamily, office, industrial, easements, air right, water rights, and even a vacation home held for investment, which I'll touch upon, and then fractional ownership, which is that Delaware statutory trust. So like kind, super broad. We're going to look at it in a moment about converting a rental to a residence or vice versa, because there are other planning opportunities. But the next slide talks about a real important concept, particularly here in Colorado. We have so much in the way of recreational properties, whether it's at ski resorts or whether it's a ranch or farm or even a hunting destination. A vacation home that has never been rented, has zero rental income, cannot be exchanged. So you've got to rent the property out and have rental income. So a second home does not qualify for an exchange. But fortunately, we got some great guidance from the IRS. You'll see on the screen, Revenue Procedure 2008-16 provides what is called a safe harbor. And that's really what it sounds like. It's a legal term, but it's exactly what it sounds like. If I'm in a safe harbor and I've got a storm out there and yet I'm inside the harbor, I'm safe from the storm. And the same thing applies to tax law. A safe harbor says if you follow these rules, the IRS won't scrutinize or challenge it. So what I want to talk about is the safe harbor that came out back in 2008. The easy way to remember this one is just think of it as the rule of twos. Number one, you've got to hold the property for 2 years. So you've got a 2-year holding period under the safe harbor. Number two, you've got to rent it out for 2 weeks in each of those years. So a minimum of 2 weeks of rental income. And if you note on the bullet point second from the bottom, you can actually rent it to family members. That's permitted as long as you do it at fair market rent. So that might be a planning opportunity. Finally, you can't have more than 2 weeks of personal use. So this is the one that we get a lot of questions on. You know, is that set in stone? And the answer is yes. The rule says you got to hold it for 2 years, rent it for 2 weeks in each year. Personal use cannot exceed 2 weeks. And this is what you need to do to follow the safe harbor. And I would just tell you, we occasionally from time to time get asked questions. Well, how is the IRS going to know if we were there more than that? And the short answer is they can easily find out. In today's, technical world where we're all connected by mobile phones and iPads, the reality is they can subpoena your cell phone records to triangulate where you're located. They can find out where you logged onto the internet to access your work email. They can find out where you charged your credit card seats. So if you say you're in Denver, but you've really been in Breckenridge for the last month, they can easily find that out. So my input would be, if you want to take advantage of this, hold it for 2 years, rent it for 2 weeks in each year, keep your personal use below. And then the last thing that I just want to mention briefly would be, if you got a property that maybe was a second home and you want to convert it into a property held for investment, you cannot use it as a second home this season, rent it out for a couple of years, and now you've converted a second home into a property held for investment. Now, these are the rules for full deferral. And, covering the basics, I want to keep this very, very simple for you. If your clients don't want to pay any taxes, they have 2 simple rules to do. Number one, reinvest all of the net proceeds. So net proceeds would be the net amount. That would be after your real estate commission. That would be after the closer's fees over First Integrity Title, after the recording fees. So it's the net amount, not the gross sales price. Number two, acquire property with the same or a greater amount of debt. So if you reinvest net equity, same or greater debt, you have 100% tax deferral. So let me walk you through a couple examples. Sell for $900,000, mortgage payoff of $300,000, cost of sale, so that's going to include your commission as a real estate professional, $60,000, leaves net equity. Now you're going to buy a property for $1.2 million. Your debt goes from $300,000 to $660,000, so you're fine there. You reinvest all of the net equity. So this is an example of 100% tax deferral. No taxes are owed at all. So there's no what we call taxable boot. Now, the next example is going to show it's going down in value. So if somebody buys for 700,000 and their debt goes from 300,000 to 260, there's $40,000 of mortgage boot. They put $100,000 in their pocket, so there's 100,000 cash boot. Add the mortgage boot to the cash boot. In this example, there's $140,000 of boot. Now, one thing to keep in mind, boot is just boot, and it's taxable to the extent you have a capital gain tax consequence. So some people may have other tax factors, things like suspended carry forward losses that could offset boot. So again, really important to meet with your tax advisor to discuss that. There are a lot of different ways to do an exchange. We're going to focus on the third bullet point, which is a delayed exchange with a qualified intermediary. 98% of all exchanges are what we call a delayed exchange with a qualified intermediary. So we're going to walk you through the mechanics of that. The way this works is up at the top is your client, the taxpayer, that's the investor. They're going to list a property with you. You're going to get the property under contract. So once you've got a buyer for it, you're going to call a qualified intermediary and get them involved in the exchange. And what they're going to do is now, as a qualified intermediary, we are going to step into the shoes of the seller. I don't know why that happened. Hopefully my screen's still up. Let me know, Aaron, if it's not. They're going to step into the shoes of the seller. The contract is then assigned to asset preservation. We're now going to go ahead and sell the property to the buyer, and then we're going to instruct the closer to directly deed the property over to the buyer. So again, I highly recommend you consider working with the closers at First Integrity Title. They're trained in 1031 exchanges. They're very comfortable with the whole process, the mechanics involved. So just to give you that background, this is the first part of an exchange. Lost the screen. Something's just a second here, everybody. I apologize. I don't know why my screen's getting bumped, but it is. Give me a second here. I don't know why. I'll be back in a second here. Share screen. Somebody's been bumping me out. All right. Okay, there we go. Delayed exchange. We sell it then. Now what's going to happen is the money comes to the qualified intermediary. So this is the first part of an exchange. We'll get into the timeline on it. Now you're going to work with your client on property you want to buy. Now, a quick planning tip. Today's market, in our market here in Colorado, inventory is very low. So I'm going to recommend, as soon as your client gets their property listed for sale, you start working on the purchase side and queuing up properties for them to buy. That would be really important. Then they're going to go ahead and make offers. You get it under contract. Now that contract's assigned to the qualified intermediary. We step in as the buyer of the replacement property. We purchase the replacement property and have that deeded back to the taxpayer to complete the exchange. So you'll see the qualified intermediary sells the relinquished property. Qualified intermediary buys the replacement property. Your client's merely giving up title and receiving title back. Now you'll see the timeline at the bottom. So let's clarify a few things. Day 0 is when the property closes. It's not when you're under contract, it's your closing date. So if you're working with First Integrity Title, you close it, that's day 0. You have 45 calendar days to identify property that you want to buy. So we call that the identification period. So it's day 0. You have until midnight of the 45th day to identify property that you want to buy. You then have another 135 days for a maximum of 180 days to close. So 0 to 45 identification period, 45 to day 180 is what we call the exchange period. Now that's the maximum time frame. It can be less. So if your client has to file their tax return, anybody that closes after the middle of October and they file their tax return on April 15th, they would potentially have a shorter time period. So just keep that in mind. The other thing that could affect it, if you have a disaster area, what's called a presidentially declared disaster area, that it makes your client eligible for a 120-day extension. We had this years ago when we had severe flooding up in the northern part of the state, that triggered in certain counties that additional 120-day extension. So 0, 45 to identify, plus another 135 days to close. Now I'm going to go back here, kind of a review. With the delayed exchange, you certainly want to have your client consult with their tax advisor and a qualified intermediary. Make sure that it's an assignable contract. Then those documents are signed prior to closing. So you can't set up an exchange after the fact. You got to get it done prior to closing. They then have the 45 days to identify property, and then a maximum of 180 days to close. This is a cooperation clause when you sell, and then we've got a cooperation clause when you purchase. If you'd like to get this, certainly reach out to us. We'd be more than happy to email this on over to you. Now, the next part would be, how do you identify property? You've got 3 different rules. The most popular rule is what's called the 3 property rule. So you can identify 3 properties of any fair market value. So if I sell for $1 million, I can identify one at $1 million, one at $2 million, one at $4 million, but I'm limited to 3. The alternative is what's known as the 200% rule. I can identify as many properties as I want, but no more than 200% of the value of what was sold. So I identify 9 properties in that example, but not over $2 million. So 3 property rule, you're limited to 3 properties, but the value is unlimited. 200% rule, I've got an unlimited value, but then I'm capped off. I'm sorry, I've got an unlimited number I can identify, but no more than twice the gross value of what was sold. And then the final one there is what's called the 95% rule. Rarely is this used. This is where somebody identifies more than 3 and more than 200%. They must actually close on 95% of the property, of the value of the property is identified. Think of it this way: if you're going to use that one, you essentially have to buy everything you've identified from a practical perspective. Now, identification, we ask, what does it look like? It needs to be written. And the key thing is you need to unambiguously describe the property. So unambiguous is going to be a street address or a legal description. You would identify it on the street. If it's a piece of land, it could be the assessor's parcel number. If you're going to identify a condo in Beaver Creek, you want to identify not only the complex, but unit number 321, the specific unit. So it has to be unambiguous. And you only have that 45-day window. Now I can identify some at the beginning, I can unidentify, and I can substitute before midnight of the 45th day. But I must buy something that I've identified. I can't find something after midnight of the 45th day and use it in my 1031 exchange. Now, I know in today's market, that's stressful. We get this comment all the time. Aaron and I hear this on a daily basis. And the reality is the tax code's been around for over 100 years, but it doesn't take into consideration our current market where it's a seller's market. So the code is constant. Right now, we've got a market with very, very low inventory. And I know as a real estate professional, this is a little bit challenging on your perspective because a property that's priced right can turn over in days or, even hours in some areas. So it's challenging. Unfortunately, the best solution I can come up with is start looking for your purchase before you actually go ahead and sell. So that's the key thing. The qualified intermediary, we're going to prepare an exchange agreement, an assignment of the contract, notice of assignment, the exchange account setup forms, and then we'll have detailed closing instructions. So when working with First Integrity Title, we'll provide the detailed instructions on exactly how to prepare the settlement statements, how to mark the 1099, everything that's involved to make it very clear what we need to do step by step through the process. This is an example of multiple properties. So here I'm selling 3 smaller properties. All the money is going to come into the qualified intermediary. We're going to go ahead and then purchase 1 replacement property that's larger and then deed it back to the taxpayer. The thing to be aware of, if I'm selling 3, let's say smaller houses, and I'm going to go into commercial, once the first property closes, that starts the 45 and 180 days for the entire exchange. So this can be done You want to make sure that you get property number one under contract, maybe have a longer closing date, and then be a little bit flexible on the actual prices of properties two and three so that you can get them done within that time period. So this is used when somebody wants to consolidate. They've got a bunch of single family rentals in town. They want to roll it all over into one larger property. The more common approach is what's done on the next slide. And this is where someone's going to sell one property and they're going to redeploy that into several replacement properties. So over here, taxpayer sells the property to the buyer. The money goes to the intermediary. They purchase three replacement properties and then have those deeded over. And that would actually be seller one, seller two, seller three. So most people in an exchange go up in value. They're going to leverage up and buy larger properties, increase their cash flow. Now, why is this great for? It's great for your client, right? They get a better return on investment. To be honest, it's really pretty good for you as a real estate professional as well. You make a commission on the sale. Now you help them purchase several replacement properties, making a commission on the purchase transaction. So your client comes up in a better position. And frankly, as a real estate professional, you're now working with that client and working both sides of the transaction and making double commissions or more. So it really is kind of a win-win situation. Now, beyond the scope of today's class is something called parking arrangements. These are much more complex exchanges. You'll hear them called reverse or improvement exchanges typically. So a reverse is where we're going to buy the new property, replacement property, close on it, and then we have 180 days to sell the relinquished property. And these, by the way, are pretty complex. We're going to form an LLC, register to do business in the state of Colorado. We're required to file a tax return with the state. There are a lot of moving parts. We're going to a lot of times need a phase one environmental report if it's anything other than residential. We're going to need to be co-insured on the insurance. These are great structures, but I just want you to be aware they're not cookie cutter. And frankly, the fees for them are several times higher than in a normal 1031 exchange. So reverse, I buy the new one first. That's a great solution in today's market where maybe you've got a great purchase opportunity available. An improvement is where we're going to build a brand new building from the ground up, or maybe we're going to refurbish an existing one. And the final one, a reverse improvement exchange, is where we're going to buy the land and then begin improving the building. And then later, within 180 days, selling the relinquished property. We did one of those recently in Colorado with a feed supply store that went to a bigger location and closer to I-25. So they had to keep their business operating, but they needed to buy the land, construct a new facility, and then within 6 months sell the existing one. So that's the way that it was done. Now I want to switch gears with you, and this is something we get a lot of comments on, which is the interplay between 1031 exchanges, which is property held for investment, and what you're all familiar with, Section 121 are the primary residence rules. So if somebody lives in a house as their residence for 2 out of 5 years, they can exclude $250,000 if they're single file or $500,000 married filing jointly. So Section 121 is actually better. It's tax exclusion. 1031 is tax deferral. You just keep kicking the can down the road over and over and over. Now, potentially forever, people like me will probably continue to exchange over and over and over, and then pass on appreciated property to my heirs with a step up in basis. So we've got this. I want to touch upon scenarios 3, 4, and 5. Split treatment, converting a rental acquired in exchange into a home, a residence, and then converting a residence you live in into a rental property. So we all know Section 121, live in it 2 out of 5 years. In a split treatment, we're now going to have a property that's part rental and part residence. Really important that you bring your client's tax advisor in to have them come up with the allocation. How much do they live in? How much is rented? If it's a duplex, it might be 50-50, but have a tax advisor involved. Only the portion that's actually rented will qualify for the exchange. So a simple example, I got a fourplex, you live in one unit, clients live there for over 2 years, they rent out 3, 25% of the proceeds tax-free or tax excluded under section 121, 75% go through an exchange. Now that's kind of simplistic. You want to look at the property. Was it fixed up? Sometimes the residence was fixed up. That's important to look at. So maybe the allocation is a little different. I'm going to share with you fairly quickly some other twists on it. We do split treatments in Colorado on ranches and farms. Look at this one, $4.6 million sale price on a bunch of land. The land's worth $4 million, 1031. The farmhouse worth 600,000. So it's a large rancher farm taking advantage of split treatment. Now the next one, what about people that do Airbnb all over the place? Very common. What if I rent out a couple of bedrooms and a bathroom? I've got $1 million home in Denver, 200,000 of it's the rental property. I do an exchange on that, and then I use the primary residence on the 800,000. Now, the next example would be, what if somebody has a $750,000 house, their entire basement is a home office, and then they live in their main floor and their upper floor. In fact, I'm speaking to you from my basement. This is a bedroom that I converted into this, and my entire basement is a home office. So this is exactly my scenario. 1/3 of it is held for investment or used in a business, 1031, and then 2/3 of it is 121. The next scenario would be where we convert a rental acquired in an exchange into a residence. By the way, I know we're sitting 7 minutes before we wrap up. I will zip through the questions at the very end as fast as I can. Now, in this one, we've got a 5-year holding period minimum. Then we've got to exclude it. So we only get credit for 121 for the amount of time it was lived in over the total ownership period. So let me give you kind of an example. Somebody does a 1031 exchange. They rent a property for 3 years, and then they change their mind, decide to move into it. They live there for 5 years. So total ownership period is 8 years. They get 5/8 of the 121 exclusion because that's the amount of time that they lived in it. So there's a benefit. And obviously, the longer you live there, the more beneficial this strategy becomes. Now, the last one's pretty interesting. What about converting a residence into a rental property? So you live in a property in, let's say, Boulder. It's your residence. You move out of it, you rent it out for a year or two. Now you can make it an investment property. So when you go to sell it, now you get the exclusion for the 121, let's say $500,000 if you're married, and the remainder now you go ahead and do a 1031 exchange into other like-kind property. So a lot of planning opportunities. Again, reach out to Aaron or I. We'd be happy to discuss the different scenarios that are available to you. Whenever anybody does an exchange, they're going to have to fill out what's called Form 8824, like-kind exchanges. They're going to have to represent when they identified the property, when they acquired it, where they do an exchange with the related parties. So your CPA will do that. And then finally, an important area with an exchange is doing due diligence. There are lots of reputable qualified intermediaries, but this is the most important thing you want to look at, which would be they're holding your money. And so you want to make sure you do some investigation into their security. Things to ask. Does that qualified intermediary, does it have the backing of a large creditworthy entity? So there are qualified intermediaries owned by title companies and banks and other entities. That's going to be able to offer a higher level of security. Where are the funds deposited? You don't want a QI to be a big depositor in a little local community bank. Particularly now, we're seeing some turmoil in the economy. We're seeing interest rates tick up. We're seeing the stock market gyrate up and down. You want to make sure that you're working with a very reputable company. And I want to show you in the next slide. Does the qualified intermediary offer a segregated account? This is really critical. So you do not want your money in any way commingled. You want a separate account for you and your client, and you don't want that commingled in any way at all. You want to make sure that's a completely separate account there. Now they can offer a qualified trust or a qualified escrow account. That can certainly be done. I'm seeing all the comments at the beginning, and there are different ways to do that. So let me go on to a couple other things to look at. If you want to contact asset preservation, my email is scott@apiexchange.com. And I encourage you to reach back out to Pam or reach back out to your local representative with First Integrity Title. If you've got questions on the closing and title side, they'd welcome the opportunity to be a resource to you on that particular thing. Finally, you're welcome to contact either me or Erin Crowley. What I'm going to do right now, who works with me, she's based in Denver. She and I are both experts on 1031 exchanges. I'm going to go through the questions here and try to answer them. From Brendy Miller, how long do you have to hold it? There's no holding period. I covered that earlier. It just has to be held for investment. From Kurt, would a seller be able to use funds toward previously owned properties to pay down debt? Kurt, no. You've got to acquire a new like-kind property. You can't use it to pay down existing debt. To Mark and Cindy, yes, we're going to make the slides available to everybody as a PDF, and then we'll have a recording of this as well. So if you want to go back as a refresher, the slides will be available, and we'll go ahead and make this available. Brandy, can you reinvest the net profits between the down payment and renovations? Short answer is yes. There's something called the improvement exchange, but it's more complicated. So if you're going to be doing $5,000 of renovations, right? New tile in a bathroom, it's not going to make sense. If you're going to be doing $100,000, $200,000 of renovations, it could make sense to do that. Amy, what is considered identifying replacement property? We touched, it's got to be done in writing and ambiguously described and sent into the qualified intermediary by midnight of the 45th day. India, if the owner of the property has been transferred and exchange passes away, does the exchange end there or is it inherited? Great question. A little complicated. Most people proceed, but you will get a step up in basis at the time of death in that particular scenario. So that's how that is treated. And then I just want to leave you, with an important concept, which is, at asset preservation, I mentioned we can't give tax or legal advice, but we certainly welcome the opportunity to field questions as they come up. So my phone number, by the way, I didn't have it on the other screen, is 888-531-1031. So I'm down here in northern El Paso County. Erin's up in Denver. Both of us are available to answer questions for you. And then when you if you got questions on the title side, or you got questions on the closing statements or how that's handled, please reach out to your representative with First Integrity Title. They'd welcome the opportunity to do that. And just to give you the background, they really understand the 1031 process. So you can feel comfortable, you being a transaction to First Integrity Title. They'll work seamlessly with us, making a very smooth closing for you, something that closes on time and making the process very smooth for both you and your clients. And with that, we're going to go ahead and wrap things up. Sorry about a little bit of hiccups. I'm not sure why the presentation would go away when screens were shared there, but we'll get this out to everybody. I want to thank you for your time. As follow-up, couple housekeeping things. You'll get an email from us with a form that you've got to sign that you were on board for the entire class. We'll then follow up and get you the CE certificates and follow up electronically, getting those on out to you. So thank you for your time. I hope you got some value, and hopefully you learned how to put some deals together. And now you all know who your partner should be when you want to work on the closing side with First Integrity Title and on the exchange side with asset preservation. So thank you very much. Bye, everyone.